All right, let's dive straight into this explainer and look at how HSBC, a massive institution sitting on over $3.3 trillion in assets across 56 countries, is using the month of August 2026 to fundamentally transform its global strategy. We're witnessing one of the world's largest banking organizations execute a textbook pivot, shedding its legacy weight so it can accelerate into a highly digital future.
Here is our roadmap for today. Record profits, shareholder returns, trimming the fat, balance sheet optimization, and finally, the digital future. Let's get right into it.
Section 1. Record profits. To really understand this pivot, we got to look at the financial engine powering it. The windfall from their August 4th interim results was, frankly, extraordinary. Analysts had forecast about $18.9 billion, but profit before tax blew past that, hitting a staggering $19.5 billion. Add in a profit after tax of $15.3 billion, and yeah, they comfortably beat the street's expectations.
Put simply, that translates to a massive 23% year-on-year surge. We are looking at a $3.7 billion increase in profit compared to just the first half of 2025. That is a tremendous amount of newly generated capital.
And this success wasn't just a lucky break in one area, it's broad-based growth. Banking net interest income climbs $22.9 billion on the back of strong deposit balances and higher yields. Total revenue jumped 11% to $37.7 billion, but the real standout here, wealth revenue. It saw an 18% spike year-on-year, with their Asian markets, specifically Hong Kong, sitting front and center of that success. And to top it all off, their return on tangible equity hit 19.5%, well above their 17% target.
Group CEO Georges Elhedery wasn't shy about this momentum either. He stated that HSBC is becoming the stronger bank they set out to build. That quote really hits the nail on the head for our overarching theme today. They aren't just making money, they are executing their strategic priorities exactly as planned, with incredible pace, precision, and discipline.
But, to keep things totally objective, we have to point out it wasn't perfectly smooth sailing. While they actually upgraded their full-year net interest income guidance to at least $46 billion, they did face some headwinds. Expected credit losses came in at $2.4 billion. That's about $400 million higher than the same period last year, mostly driven by two specific events: a $400 million hit from a British financial sponsor fraud case, and a $200 million drag from Hong Kong's commercial property sector.
Section 2. Shareholder returns. Let's look at how these massive profits are actually reaching investors. Sitting on a very strong 14.1% capital ratio, HSBC ended a three-quarter pause by launching a brand new $1 billion share buyback program. Throw in a second interim dividend of 10 cents per share, bringing the total half-year dividend up to 20 cents, and the market reaction was immediate. Their Hong Kong-listed shares actually broke all-time highs, pushing above 160 Hong Kong dollars.
But here is the underlying tension. Citi analysts quickly pointed out that this $1 billion buyback actually fell quite a bit short of the $2.2 billion consensus expectation, which begs an absolutely crucial question for the market. Is this lower amount a conservative downgrade to quarterly buybacks going forward, or is it just a strategic stepping stone while they ramp their capital returns back up?
Section 3. Trimming the fat. That question of capital allocation naturally leads us right here. To truly understand where the bank is headed tomorrow, you have to look at what they are actively leaving behind today. Since early 2025, HSBC has announced 15 different market or business exits. It is a relentless pace of strategic simplification. We're talking exiting Australian retail, planning a sale in Malta, a massive $2.1 billion sale of their Singapore insurance business to Allianz, and most recently an agreement to shed their Egypt retail branch for an expected $300 million pre-tax gain by late 2027.
The Egypt deal is a brilliant juxtaposition of their wider strategy. They are completely amputating the traditional retail side, the loans, the deposits, the customer accounts, to get much leaner. But they are fiercely retaining their corporate and institutional banking footprint. They want to keep serving those highly profitable wholesale and multinational clients. So they aren't abandoning markets, they are surgically removing the lower margin operations.
And these aggressive trims, they're paying off in a big way. Because of this strategic simplification, they've actually upgraded their annualized savings target from $1.5 billion to a solid $2 billion by the end of 2026. This is huge. It allows them to redeploy roughly $1.8 billion of capital away from non-strategic activities directly into priority growth areas. For anyone watching legacy banks struggle to innovate, this is a literal masterclass in freeing up cash.
Section 4. Balance sheet optimization.
Before we look at where that newly freed up cash is going, look at how confidently they are managing their existing obligations. On August 13th, HSBC announced the results of tender offers for their outstanding notes, and they actually bumped their maximum tender offer up from $5 billion to $6.75 billion. They ultimately accepted nearly $4.9 billion in principal for settlement. It's a highly technical move, but one that signals incredible balance sheet strength to the market. Unsurprisingly, it bumped their Hong Kong shares up by almost 1.5%.
Section 5. The Digital Future.
Now we reach the climax of this explainer. How is HSBC shedding the past to grow into a technologically advanced powerhouse? First, they are aggressively expanding in Asia by launching a global AI center of excellence in Singapore slated for the second half of 2026. And they aren't just dabbling here. They are hiring over 100 dedicated AI specialists and another 100 wealth managers. The goal is to completely revolutionize their operations, from deeply personalizing wealth management conversations to introducing autonomous, agentic treasury solutions and expanding AI-enabled digital payments.
Second, and this is truly groundbreaking for a legacy bank of this scale, they are pioneering the digital asset space. Following a landmark license from the Hong Kong Monetary Authority, HSBC is preparing to launch a fully backed Hong Kong dollar-denominated stablecoin. Crucially, this isn't some unbacked crypto experiment. Every single digital token will be fully backed by high-quality liquid assets held securely in segregated accounts.
And this is where their massive legacy scale becomes an absolute superpower over typical crypto startups. They aren't launching this stablecoin into a vacuum. They are integrating it directly into PayMe, which already serves 3.3 million users, and straight into the HSBC Hong Kong mobile banking app, an app that just saw a 20% year-on-year increase in active users. They're instantly enabling seamless peer-to-peer payments, merchant transactions, and tokenized investments for millions of people on day one.
As HSBC Hong Kong CEO Maggie Nang stated, they are delighted to participate in this pioneering regulatory regime. They are moving incredibly fast, deliberately positioning the bank at the very center of Hong Kong's ambition to become the ultimate global digital asset hub. The scale of this ambition is just phenomenal. Which leaves us with this final thought. HSBC is in the middle of a massive pivot. They are rapidly trimming away their legacy retail operations to bankroll a high-tech, AI-driven digital asset future. They have the capital, and they clearly have the ambition. But as a legacy titan attempts to out-innovate agile fintechs, you have to ask, will this massive gamble secure their dominance for the next century? Or is this just step one in a completely redefined global banking landscape? Thanks for joining this explainer, and we'll catch you next time.